in our quest to find and understand cycles and try and profit out of them, I'm creating this video for you that I'm hoping you're going to find very valuable. It is slightly different to all of my previous videos and commentary and analysis. It is not entirely on property. It's about a slightly different market that most people would be familiar with, but they're probably still too afraid to invest in because of what happened in dot-com bubble, then in 2007, 8, 9 global financial crisis. Everyone seems to believe that the property is the place to put your money, but if you're a serious investor, if you look around, you'll realize that most serious investors don't invest in property because of many factors. It's very slow moving, it takes a long time to buy it, it's expensive, stamp duties, you got to pay lawyers, real estate agents when you're buying, of course when you're selling as well, and then you have to pay tax, capital gains tax to the government. Yes, you have to do a lot of these things, well, especially capital gains if you make money in any other asset class. But yeah, I'm just, as you can probably tell, not a big proponent of property. But let's see where else we can put our money and what this particular analyst, which I really like his train of thinking, thinks about it.
Well, global investors have not been running but jogging with the bulls. On Wall Street alone, the S&P 500 is up more than 300% since the last crash in 2009. And that's a red flag for some market watchers, as hot share prices raise the spectre of a possible crash. But Citi has developed a crash checklist and says we're nowhere near panic level. Top global equity strategist for Citi is Robert Buckland, and he's dubbed it the most miserable bull market he's seen. I caught up with him between investor briefings in Sydney. Robert Buckland, we've had 8 straight years of gains on global markets. In anyone's language, that's a fantastic bull market. But you think it's the saddest one you've ever seen. Why?
Yeah, it just feels... the mood out there that I pick up from investors, you wouldn't think the share price would be going up for 8 years, right? There are all sorts of reasons for that, but it's twice the length of the last bull market, so that was only 4 years. So, some people are very worried about this. They think it's overextended and that we're due a big correction.
And so do you think we're due a big correction, or has this bull market not been bullish enough in order to justify a giant crash?
Yeah.
Look, the interviews kind of started a little bit slow, but I urge you to stick around because he makes some really good points that coincide with my other research.
I just don't think enough people have been sucked into this in the way that they usually are at the top of bull markets to then spit them out the other side, which is what drives a bear market. So even though it's tempting to say 8 years is too long, too old, we're due a big correction, all these sorts of things, I don't think that's going to occur.
So not enough people have been, that's the point number one, not enough people have been sucked in. So we clearly now, you know that we're talking about the share market. So you have to have enough people, retail investors, mums and dads, call them whatever you will, sucked into whatever the asset class we're talking about. So what he's saying is that there just isn't enough of these retail investors that have bought into the share market, because that's how bubbles are created. And as he said, when enough of them are sucked into it, then they get spit out on the other end and they pretty much lose the money, which I think is what's happened with the property. So we're just waiting for that spit out phase where people start hemorrhaging and losing money on it. But I think this guy's onto something. This coincides with my research, particularly with Martin Armstrong, who is going against the grain and telling people that the stock market will go a lot higher. It's not a bubble, but don't take my word for it. Listen to this analyst. This is not bad.
You've put together a checklist of 18 things that sort of went red in your scale when we saw the crash in 2000 and when we saw the crash in 2007. How many of those 18 items are red now?
Well, we've only got up to 2. We're up to 2 out of 18. as you say, typically we'd see 13, 14, 15, 16, 17, even 18 out of 18 telling us that things were really overcooked at the top of previous bull markets. We're only up to 2.
And what's on the checklist? What are you looking at?
Well, if you want to, let's focus on the 2 that are scary first. The 2 that look most scary to me are valuations, which are definitely starting to look a bit rich globally, and the second one is corporate balance sheets, which are starting to look extended. But the other 16, not particularly worrying at all.
So if we have listed corporates who have really expensive shares on your chart and they have heaps of debt, that's not enough to bring it all down?
No, because there are all sorts of other things that play a part in bull markets. Investors pile in, right? They all start buying equity products, or bosses dive into lots of M&A, or we start seeing lots of capex. Those are the things that are missing in this bull market that we've seen in the past.
Well, one thing your checklist doesn't have and can't have is the withdrawal of QE, because we have never seen it before. How do you think that is going to rate?
I mean, that's the great unfathomable, right? You know, my checklist is about things we've seen in the past that we're looking for to happen this time round. But as you say, QE, we've never seen this one before. You know, that's the really weird thing that's going on in global financial markets in this cycle compared to previous ones. I mean, my fixed income colleagues are worried about it. Hardly surprising, given that...
All right, he says fixed income colleagues are worried about it. You know, in my limited economical and financial investment knowledge, I think he's talking about bonds. So this QE tapering that central banks are talking about will probably affect the bond market, which I'll spoil it, but he says that is probably going to drag the share market down in the short term, but eventually share market's going to recover. So bonds, stay out of bonds. I know most people don't know what that means, but if you've got a superannuation, your pension fund, or any other way that you think or you know is investing in bonds, get out of it, because the bond bubble is going to blow up, but not the share market, because everybody loves talking about obviously a property market bubble. It's going to burst, it's going to crash, but we have a stock market. The stock market is going to crash. No, what everyone is saying that I follow that is kind of a contrarian is that if we have any sort of little pullback, it'll only be that. It'll be a correction, but after that it's going up and up and up.
Banks own 40 to 50% of their market in some parts of the world. Taking that 40 to 50% buyer of their respective markets out of the game could represent a major challenge. So I think it's going to be tricky.
Crash? Could it start a crash?
Yeah, it might drive a crash. I think fixed income markets are the most vulnerable to that, because they're the ones that, of course...
Here we go. Again, it's the fixed income markets. It's the money markets, bonds. So stay out of them. Sorry, I've said it before.
Seen the massive buying by central banks through this QE policy. I think the stock market might see a short-term correction on the back of that. But my definition of a bear market is not a short-term correction. My definition of a bear market is when the market goes down, you still sell it. That's what a bear market is. A correction is when the market goes down, you buy it. And that's what was the right thing to do last January. And I think if we do see a correction this year on the back of QE, we would recommend to our clients to buy into it.
So if we do see a correction, again, don't be spooked out, get in. That's the message. Now, how do you know that it's just a pullback and not a start of a bear market? Well, nobody knows if it's going to continue to go down when it starts going down, and you got to have a really good stomach to get into the share market when it's correcting, because again, there's no guarantee that it's a short-term correction or start of a bear market. So I'm hoping, and I hope you do as well, I'm hoping to be able to capitalize on the next pullback. I know that's what most people are thinking about, and that's the strategy, but you know, once it starts breaking, you know, it's really hard to part with your money during those times, but apparently that's when smart investors make money.
The other issue that you've got on your checklist is valuations. I mean, everyone is talking about how expensive stocks are at the moment, particularly when you look at sort of what they're producing, what they're earning. We're in US earnings season now. Yeah. It's okay, it's not great, but their share prices are at record levels.
Sure.
I mean, Do you see this could possibly keep going?
Sure. I mean, the thing about valuations is that they're a necessary yet not sufficient condition for a bear market, right? So I think that valuations are starting to look rich now, but people are saying to me, Rob, do you think valuations are in bubble territory? No. So my definition of how to use valuations right now would be, I think stock markets are expensive, but I don't think they're yet in a bubble. In the late 90s, global equities trade currently on about 21 times earnings. In the late 90s, they got to 30, 35 times earnings. So another 50% higher than where we are now. So expensive, but not a bubble.
So what does that mean for...
He's great. Expensive, but not a bubble. Exactly what I found to be the case.
Investment strategies? I mean, we've seen a big shift towards passive and active.
Yeah.
There's a big debate on, where people should go and what we should be doing, knowing the unknowns about QE, etc. What's your view?
Equities are kind of best of a bad bunch, if that's the right way to put it. So we've all got to save somewhere, and what we would probably recommend that people should do is keep some money in cash, because all assets are expensive. But if you are going to buy financial assets, equities are the least distorted, we think, by super cheap money in this cycle relative to other asset classes.
Robert Buckland, it's been great to have you on the program. Thanks so much.
Thank you.
Great interview, really well done. I'm really happy that I've seen this. It's kind of confirmed my existing research. Maybe it's confirmed my bias against investing in residential property. But time will tell. I'll let you know how I go when hopefully the stock market starts correcting. Whether we're going to get in and get some of the really good companies, good stocks, and buy them up when they're cheap. Until then, talk to you later.
I just don't think enough people have been sucked into this in the way that they usually are at the top of bull markets to then spit them out the other side, which is what drives a bear market. So even though it's tempting to say 8 years is too long, too old, we're due a big correction, all these sorts of things, I don't think that's going to occur.
My next video is on the top right hand corner. Please click on it and enjoy.